Inheriting a property, especially from your parents, is a really emotional time. And honestly, the last thing you want to be worrying about is a surprise tax bill. But for a lot of people, that's the reality with something called capital gains tax. So, over the next few minutes, we're going to break down exactly what you need to know so you can handle it the right way.
Now, this discussion has been put together with the help of the experts over at My Tax Accountant. They've shared their know-how to really help simplify what can feel like a super complex topic.
Okay, so let's get right to it. The one big question that's probably on your mind and causes the most stress. Do you have to pay a bunch of tax the second that house is legally in your name?
And the answer, thankfully, is a big, clear no. Just inheriting a house isn't a taxable event in the eyes of HMRC. The clock on capital gains tax, or CGT, only starts ticking if and when you decide to sell the property later on.
So if you do end up selling, everything, and I mean everything, hinges on this one number, the probate value. Now listen up, because this is important. This is not what your parents paid for the house years ago. It's the official market value of the property at the time they passed away. That number is your starting line, your base cost for any tax calculation.
The actual calculation can look a bit intimidating, but it's really just a four-step process. First, you work out the gain. Then you take away any allowable costs. After that, you apply your tax-free allowance. And finally, you work out the tax on whatever is left. It's pretty logical when you break it down.
And here's the first bit of good news that helps reduce the bill. Every single taxpayer in the UK gets a tax-free allowance for capital gains. For the 2025-26 tax year, that's £3,000. Just think of it as a tax-free buffer. It's a use-it-or-lose-it deal each year.
Okay, now this is a really crucial point that catches so many people out. The tax rate you pay on the gain isn't just a fixed number. What you have to do is add your taxable gain on top of your regular income for the year. If that total amount still keeps you in the basic rate tax band, then your gain is taxed at 18%. But if it pushes you up into the higher rate band, that chunk of the gain gets taxed at 24%.
So, we know how the tax is calculated, right? But what about the big one? Is there a powerful way to significantly reduce that bill or maybe even wipe it out completely? Well, yes. There is one major strategy you need to know about.
It's called Private Residence Relief, or PRR for short. And honestly, it can be a total game changer. The idea behind it is really simple. HMRC doesn't charge you capital gains tax on the sale of your main home. So if you move into the house you inherited and make it your actual main residence, you could potentially wipe out a huge slice of the tax bill. But, and this is a big but, there are strict rules. You have to genuinely live there. It has to be your home. The time you live in the property is exempt from tax, and here's a great little bonus. The final 9 months you own it are also exempt, even if you've already moved out. Just be really careful, though, because if you rent the property out at any point, that will reduce the amount of relief you can claim.
You can also chip away at your tax bill by deducting certain costs, but you've got to know the difference between an improvement and simple maintenance. Think of it this way. Capital improvements, like building a brand new extension or doing a full kitchen renovation, you can deduct those from your gain. But routine stuff, like repainting a room or fixing a leaky tap, that's just maintenance, and you can't deduct it. This is why keeping receipts for any big work is absolutely vital.
So, what happens if you inherit the house with your brother or sister? Well, here's some more good news. The tax system treats you as separate individuals. The total gain from the sale is split between you, and each of you gets to use your own £3,000 tax-free allowance against your share of the profit.
Okay, I need you to pay really close attention to this number, 60. This is a deadline you absolutely cannot afford to miss. From the very day the property sale is completed, you have just 60 days to work out and report the capital gain to HMRC. It's a notoriously tight turnaround, and it catches thousands of people out every single year, often leading to fines.
So, what do you actually have to do? Well, the reporting is basically a three-stage process. First, get all your paperwork together. That probate valuation document is the key one. Second, you have to go online and use HMRC's service to report the gain, and you have to do that within that 60-day window. And finally, you need to pay any tax you owe by the 31st of January of the next tax year.
Look, while the ideas are fairly straightforward, the little details really matter. When you're juggling tax reliefs, trying to figure out deductible costs, and you're up against those tight deadlines, it's just so easy to get things wrong. And that can mean you either overpay on your tax or you end up facing penalties. This is where getting some professional guidance can be a lifesaver.
The main takeaway here is this. Inheriting a house doesn't automatically mean you're inheriting a massive tax headache. With some careful planning and by understanding the rules, you can make sure you pay exactly what you owe and not a single penny more. So if you have any doubt at all, it's always worth speaking to an expert. You can get in touch with the team at My Tax Accountant by email at info@mytaxaccountant.co.uk, or you can reach them by phone or WhatsApp on 07854 255 375.